I said financial accounting is worried about the past. Now, but when you are making a credit decision, not only consider the past, you have to worry about the future as well. Especially in this pandemic situation. Now, I would like to take an example why we need to worry about the future also. To take in 2006 or 2007. The first company in the history of Sri Lanka to record a 10 billion mark. 10 billion mark is a telecommunication company, right? You may know the name, but I do not want to give the name. They were the first company, right? Have a profit after tax figure of 10 billion. Next year, what has happened? If you take that particular year, all the ratios are very attractive. Not only attractive, very substantial, attractive. Everything is there. Every bank would like to give loans, everything. Not only that, every employee in other organization would like to join that company, because that was the first company to hit the profit figure of 10 billion in the history of Sri Lanka. Then what has happened in the next year? Next year, they had a loss of 300 million, 300 million, 0.3 billion, 300 million loss. Last year, 10 billion profit. Next year, 300 million loss. Right? Therefore, if you take all decision based on the last year performance, right? Now this particular company, nothing was happened, but that was the figures, right? Nothing was happened to the company, but if you took a decision based on last year figure only, then you will be in a big trouble situations where you have not worried about the present and the future figures. Make sure before you taking a credit decision, not only worried about the past, make sure that you worried about the some aspects of the future as well. Therefore, for you to take that decision, the management accounting and cost accounting will get help out, right? Then this is the subject for the day. That is double entry system. Double entry system. If you have learned accounting, right, you may also wonder why this particular lecturer teaching you the double entry system. But most of the people who have learned accounting, they forget about this system of double entry. If you take the subject of accounting, it cannot be by hearted, right? Only one thing you can by heart under accounting, that is this double entry system. Apart from the double entry system, everything should be questions and answers should be asked, right? When you are doing any accounting, you have to question all the things apart from the double entry system itself. Now, what is double entry system? Double entry system is a system where you have every transaction, you have a debit entry to one account and a credit entry to another account in the same value, right? A system where you have a debit entry for a transaction and a credit entry for the same transaction in the same value, right? By doing so, every transaction will have a debit and a credit entry, and by doing so, at the end of the year, the total of the debit transaction and the total of the credit transaction will get tallied. And a famous Italian called Luca Pacioli, he introduced this double entry system, right? This is what he introduced. He said there are 5 categories of accounts for which you can do the debits and credits, right? And he said every time the 5 categories are asset, liabilities, income, expenses, and equity. Every time asset account should have a debit balance, liability account should have a credit balance, income credit balance, expense debit balance, equity credit balance. Right? He further explained due to a transaction, if an asset increase, due to transaction, if an asset increase, you should debit that asset account. If due to a transaction an asset decrease, you should credit that asset account. Similarly, for a liability, due to a transaction, if a liability increase, you should credit that liability account. Due to a transaction, if a liability decrease, you should debit that account. Then for income, increase credit, decrease debit. For expenses, increase debit, decrease credit. Equity, increase credit, decrease debit. Now in accounting, this particular double entry system, you have to buy hard. You have to buy hard this particular double entry system. Other than this double entry system, you every transaction, every entry you can question. There should be a reason for every debit and every credit. There should be a reason other than this double entry system. But don't question this double entry system. Why? This was the system introduced by the Luca Pacioli, right? You cannot ask a question from me, why, sir, an asset account have a debit balance? Why we debit when an asset increase? Why we credit when an asset is decrease? Don't ask that question, right? It is the system implemented by Luca Pacioli. If he at the implementation, if he said an asset account should have a credit balance, then I will explain to you it should be credit balance. But unfortunately, he said asset account should have a debit balance, right? Therefore, this double entry system itself you cannot question. There are some there are different things you cannot question. It is there, right? I am sitting in a chair. Don't ask why we call this particular item a chair, right? I am looking at a monitor. Don't ask question why we call this particular subject a monitor, right? I have a water bottle. Don't ask why we call this a water bottle, right? Therefore, there are things you cannot question. Similarly, when a theory is developed by a particular person, don't question that, right? And we are using that theory, and don't question that, because there won't be any answers, right? Right. I will give 1 or 2 minutes for all of you to, there are about more than 100 people, for all of you to by heart this double entry system. I will give 1 or 2 minutes. I will use this system of double entry system, double entry in the entirety of this balance part of the session, right? Therefore, you have to by heart. Apart from the double entry system, nothing has to be by hearted. Everything has to be questioned. And you can easily by heart this thing. You have to remember only the first 2 columns: account category, asset, liabilities, income, expenses, equity, and the balance, debit, Asset account debit, liability account credit, income account credit, expenses debit, equity credit. There are only 2 debits and 3 credits. And increase column is identical to the balance column, right? If you take the balance debit, increase also debit. If you take the balance credit, increase also credit. And if you take the decrease, the other side of the entry. If the increase is debit, then decrease is credit. Only 2 things, but make sure that you correctly by heart this thing. If one item is wrong, the other item will get automatically wrong, right? There is a 50% probability for you to get erroneously by hearted the double end systems. Therefore, you have to worry about the first 2 columns, count category and the balance, then the balance identical to the increase column. For the benefit of all the people, because some may not know about the next week onwards, that make sure that you all people log into not only not at 8:30 a.m. It will be started from 7 a.m. 7 a.m. I will repeatedly say this time difference due to because I am conducting various lectures, and due to a difficulty of having the lectures at 8:30, I will start at 7 and make sure complete it before the time allocated. Make sure that you all log into the system at 7 a.m. 7 a.m. right? 7 a.m. is not a difficult time for you to log, because then nowadays it will be difficult for me to come here at 7 a.m. But for as far as UI is concerned, there is no preparation for you to come to here, no. Therefore, ගෙදර ඇන්දේ උඩ ඉඳීම ඔයගොල්ලන්ට log වෙන්න පුළුවන්. අය මොනෝ දන්න මේ කිසිම එහෙම ප්‍රශ්නයක් නැහැ. There is no requirement for you to iron the your shirt, whatever the trousers, right? No need to brush your teeth, have a bath. Nothing has to be done. At 7 a.m. you have to only wake up and log into the system, right? I think now you have by hearted the double end system. Now we're going to have some exercises, right? Right. Now I mention these 5 items as the account categories. Now, before you record transaction based on the double end system, you have to know what is an asset, what is a liability, what is an income, what is an expenses, what is an equity, what are the characteristics of an asset, right? Now we are going to learn those things also. You take assets, right? Now at the beginning of the lecture, I said when I was conducting a differentiation, I asked question from senior set of bankers, what is the biggest asset in your balance sheet? Then there were different answers, right? But if you take the definition of asset, right, it should generate some income to the organization. An asset should generate some income to the organization, and it should be owned by the entity, right? Now I go to the same example in a bank. What is the biggest income generating item? What is the biggest income generating item? Biggest income is the interest income. Interest income derived from loans and advances. Therefore, the main asset is loans and advances, right? This income generation activity may be directly or maybe indirectly, right? For a shorter period of time, for a longer period of time, right? If you take this business organization, this institute, IBSL, I am sitting in a building, right? Building classroom, right? If you take this particular building, it is an asset to the organization. Why? It will help this organization to generate income directly or indirectly, long term period, right? Nowadays there are no students, but once it is settled down, the students will come here. For students to sit, there should be a building. We cannot have classes in the roads, no. Therefore this building has to be there to conduct lectures. Therefore the building helps generating income for this institute. Therefore the main characteristic of an asset is it should generate some income to the organization. It should generate some income to the organization, right? And the other thing, if you take the financial statement, main two financial statements are statement of financial position, that is balance sheet, and income statement, that is P&L, right? If you take assets, assets are recorded or assets are presented in the balance sheet. Out of the 5 categories, asset, liabilities, and equity will be presented in the balance sheet. Income and expenses will go to the income statement, right? Income and expenses will go to the income statement. Asset, liabilities, and equity items will get presented in the balance sheet. Balance sheet, right? Now, as I mentioned earlier, an asset account should have a debit balance. Due to a transaction, if an asset increase, it should be a debit entry. Due to transaction, if an asset decrease, it should be a credit entry, right? And based on time, based on tangibility and other basis, assets can be categorized, right? Few examples for an asset in a normal business organization. This is not for a bank. Cash, land, building, equipment, inventory, vehicle. Accounts receivable means debtors, right? Normally asset should be controlled and owned by the entity, right? Then based on time, assets can be categorized into non-current assets and current assets. To take non-current assets, those assets will give income for the entity for more than 1 year, right? They generate, non-current assets generate income for more than 1 year. If you take a current assets, those assets will generate only for a shorter period of income, right? Now, if you take non-current assets, examples are building, motor vehicles, furniture, office equipments, those are non-current assets. If you take current assets, inventory, debtors, cash, those are current assets. Normally, current assets are used for working capital purposes. Non-current assets are used to generate income, that is the production or rendering of services, or for administrative purposes, right? For a long-term purposes, we use non-current assets and they generate long-term income. But as far as current assets are concerned, mainly for the working capital purposes, they only last for few months, right? Then based on tangibility, we can categorize tangible assets and intangible assets. The bulk of the asset, more than 99% of the assets are tangible assets where you can touch, you can feel, you can hit those assets, right? Physically, there is an asset. But when it comes to intangible assets where they generate income to the organization, but you cannot smell them, you cannot touch them, you cannot hit them, right? But they will generate income. To take a building, that is a tangible asset. You can touch, you can hit, you can smell, right? But if you take a debtor, that is an intangible assets. When you do a credit sale, you you will have a debtor. That particular debtor is an agreement, right? There is a debtor called a person, but that person you can touch, you can smell. But here debtor means we are referring to the agreement between that particular person and the entity, not the physical person itself. Therefore, debtors are intangible assets. If you take investment, those are also intangible asset. If you open a fixed deposit, that is an intangible asset. You may say there is a physical document of fixed deposit receipt, but that is not the case. We are referring to the agreement between the bank and the particular customer. Therefore, investments are also intangible assets. Therefore, there are some assets you can touch, you can feel, you can smell, and there are some categories of assets you cannot smell, you cannot touch, but they generate income to the organization. Those are called intangible assets. In under other categories, there are assets called fictitious assets. Those are bogus assets. They don't generate any income. Those particular asset, fictitious assets, are for a particular time period. Those are normally referred to as uh, capitalized expenses for a time period, right? I'm not going to explain the fictitious asset in detail, it will take some time. Therefore, make sure for the time being, those are not real assets. Those are bogus assets. The name itself explains fictitious assets. Then come to the second category, that is liability. Liabilities are commitments. When you are doing business, you commit various things. When you commit something, there should be a repayment. When you commit something, it has to be repaid by way of cash or by giving another assets. Like assets, liabilities are also shown in the statement of financial position, that is in the balance sheet. Right? Liabilities are also shown in the balance sheet, statement of financial position. Then as explained previously, balance of a liability account: credit, increase credit, decrease debit. Now, few categories of liabilities in a normal entity: wages payable, taxes payable, accounts payable, creditors, right? Then if you take a bank overdraft for a normal business is a liability. But from the point of view of a bank overdraft is what? Bank overdraft is, it is an asset, right? But from the point of view of a customer or normal business organization, bank overdraft is a liability. But the point of view of a bank overdraft is a asset because it generates income. Basically that. Bank overdraft generating income for the bank. But if you take a normal business organization, that is a liability. We have to repay bank overdraft. Right. Creditors claims on assets. Then liabilities can also be divided into based on time and based on nature. If I take the nature first, in accounting, we take all the accounting entries from the point of view of the business, not point of view of the owner, right? Even the owner, when he puts money, from the point of view of the business, we say it has to be repaid in a 1 day. Even though owner puts money into the business, we are looking at every transaction from the point of view of the business. Even the owner puts money, we say it's a liability to the business, right? We normally say it's an internal liability. Internal liability, right? Internal liability. Therefore, by nature, there are two categories of liabilities: internal liabilities and external liabilities. Under internal liabilities, we say owner's capital. When owner puts money, that is called internal liability. Then other than owner, every other thing that we have to pay, that the business entity will have to pay, are called external liabilities. And for internal liabilities, we have a separate name allocated that is called equity. Equity. Equity, we have a different categories under that 5 category, because we have to give prominence to the owner. Therefore, we have from the liability category, we have uh, uh, divided into two. The external liabilities are called normal liabilities. Internal liabilities are called equity, right? I'm referring to the that 5 categories: asset, income, expenses, and last 2 items, equity and liabilities. Equity and liabilities, all are liabilities. Equity means internal liability. Normal liability means external liabilities. Now, when it comes to the timing, based on the timing, liability can be divided into two. Normally, based on timing, we categorize the external liabilities. External liabilities, not the internal liabilities, because internal liability by nature it is long term. No need to classify based on time. Now, if you take the time means normally 1 year period, less than 1 year period is called current. More than 1 year period is called non-current. Now, when it comes to the non-current liability, the liabilities that we take more than 1 year to repay are called non-current liabilities. If a liability will get paid within 1 year, those are called current liability, right? If you take current liability, normally we say creditors, bank overdraft, those are current liability, because we used to repay those liabilities within 1 year. If it is a bank loan, it is a non-current liability, because it will take more than 1 year to repay that particular bank loan, right? Then equity we have already discussed, that is internal liability, right? If you take in Sri Lanka, there are 3 categories of business organization, that is proprietorships, partnerships, and companies. Equity will get differently explained in each category of these companies. If you take a proprietorship, equity normally referred to as the capital account. Then if it is a partnership, equity means capital and current account, right? Company means stated capital and reserves, right? When you are going through your financial statement provided by your customers, if it is a partnership, there should be capital and current account to represent the equity. If it is a proprietorship, the capital account itself explains the equity part. If it is a company, normally it is referred to as stated capital, and plus there is something that is reserves, undistributed profit, right? Then equity also shown in the statement of financial position. The balance of equity account: credit, increase credit, decrease debit. Right. These are some examples for equity. Dividends, when you pay dividends, equity will get decreased. Then when you additionally contribute capital, equity will get increased. When there are retained earnings like reserves, your equity will get increased. Then the third category is, fourth category is expenses. You know what are called expenses. Expenses are the payments made or due to be made by an entity to generate income. When you are to generate income, you have to incur some expenses. Without incurring expenses, you cannot generate the income. No need to further explain expenses. Expenses are shown in the income statement. Normally, debit balance, increase debit, decrease credit. Expenses can also be categorized into two parts based on the nature, recurring and capital expenses. I have a small explanation on these two. To take a, I will take an example to explain the capital and the recurring expenses. Two examples are when you acquire land for a company, that is a capital expense, right? When you acquire land, say 10 million worth of land, that is a capital expense. When you are paying electricity bill, that is a recurring expense. Electricity bill for a month, that is a recurring expense. Now go to the points I have made. Capital expenses not occur on a frequent basis. I said acquiring a land is a capital expense. Acquiring lands frequently happening or not? Not frequently happening. Therefore, not occur on a frequent basis. But recurring expenses occur on a frequent basis. I referred paying electricity, monthly electricity bills. Whether it is frequently happening? Yes. Every month you have an electricity bill to be paid, right? Then expense value is material, expense value is not material. When you acquire land, it is a material amount you have to spend, 10 million. But when it's come to paying electricity bill, the expense value is not material. Then when you spend capital expenses, a fixed assets or non-current assets will be acquired. When you spend capital expense, right, then you end up with having a non-current assets or a fixed assets. In our case, I took the example, then it will be a land for the company. Land is a non-current assets. Then these are day-to-day expenses. Now, when you pay electricity bill, there is no acquisition of non-current asset. Those are day-to-day expenses. It will go to the P&L. Then when you acquire, spend capital expenses, finally the reflect will go into the statement of financial position, that is the balance sheet. But in case of recurring expenses, it will get into the income statement. I took the example, electricity expenses. Electricity expenses will go to the income statement or the P&L. But in case of capital expenses, since we have a capital assets or the fixed asset or the non-current assets, it will go and hit the balance sheet, not the P&L. Similarly, when it comes to income, right? Last item under 5 categories, the receipt received or due to be received by an entity via selling of items or offering services. Example, if you take a bank, the main income is the interest income. If you take a normal business organization, sales is the main income item. Income are shown in income statement, credit the balance, income increase is credit, decrease is debit. Income can be categorized as follows. Based on nature, main income items and other income. I will take a bank for this explanation. If you take interest income, right? Interest income is the main income. Dividend income, bank may have invested some money in the shares of say particular two entities. They will declare some dividend and we have a dividend income. Now I am comparing interest income with the dividend income. Interest income is the main income, other income is the dividend income. Now go through the points now I am referring. Receive on a frequent basis. Interest income you get frequently, but dividend income not receive on a frequent basis. Dividend income won't get frequently. Every month you don't have dividend income. Income value is material. If you take the total of interest income, that is material. 90% of the more than 70-60% of the total income is interest income. But if you take the dividend income, income value is not material. Income value is not material. Then if you take the main income items, all main income items will get reflected in the first part. That is the main part. If you take normal business, we call the trading account. But other income will get reflected in the latter part of the income statement. Normally we referred as in the normal business the P&L, not in the main part, right? Right. We'll have a short break of 5 minutes. Otherwise, we cannot continue. Even it is online or physical session, I normally give a 5 minute breaks. Make sure that you come within 5 minutes. And before breaking for the interval, make sure that you log into the next Sunday at 7 a.m. 7 a.m. I will be there and break for 5 minutes, and I will come at sharply 10. Right. Now, up to now, you know the double end system and how it is working, like with the assets increase, debit, credit, everything you know. And apart from that, you also know about what is an asset, what is a liability, what is a income, what is an expense, equity, everything you know. And their characteristic, everything is known to you now. Now we'll go to the another concept, that is accounting equation, where uh, this accounting equation always shows the double entry system again and again. Now, if I use the uh, board for 1 or 2 minutes, right? This accounting means debit equals credit. Debit equals credit. You take the 5 categories, you know, debit items are assets plus expenses equals credit items are liability, equity, and income. Right? If I keep the assets here and taking expenses to the other side, then it will be liability plus equity, income minus expenses. When in an equation, when you take an item from one side to the other side, it will get negative. And here assets equal liability plus equity, within bracket income minus expenses. This is what it called accounting equation. If you forget about the expenses and income, assets equal liabilities plus equity. Income minus expenses mean profit. Profits will get added to the equity. Right? That is called accounting equation. We'll take some examples. Right? We'll take some examples and learn how this accounting equation will be work out. Right? Starting from only assets and liabilities and equity, we have not focused on the income and expenses, assets and liabilities and equity. Then this is the expanded accounting equation I mentioned, right? Revenue and revenue means income minus expenses. For equity, we add the additional capital and deduct the dividend. This is what I explained just now in the board. Assets equal liabilities. Assets equals internal liabilities and external liabilities. Assets equal internal liability means equity. External liability means normal liabilities. Assets equal equity plus income minus expenses plus liabilities. Right. This is the format of a ledger account where we use to record the transactions. You take a ledger account. Now in the screen you can see from the date column to the value column, right? First 4 columns are called debit side of the account. Then the balance 4 columns are called credit side of the ledger account. The first 4 columns are identical to the second 4 columns. First 4 columns are called debit side of an account. Second 4 columns are called credit side of an account. When you are debiting, you have to debit the first side. When you are crediting, you have to credit the second side, right? We'll take some examples, right? Whatever the learnings up to now will get clarified using these examples, right? I'm not trying to spend much time on a particular day because this is the first day for accounting. Therefore, make sure that you learn everything before you come to the bigger picture, that is analyzing creditors' financial statements. Now, these are very simple examples. Now, when you are trying to give an answer for these examples, you have to make sure that you take into account whatever the learnings that I told you at the beginning of this session. That is double entry system, why we debit income, why we debit assets, why we credit assets, why we debit expenses, why we credit expenses, what are the reasons, logics, everything you have to remember. Now, if you take the first example, Mr. J is the owner of this entity. He invests 20,000 cash to start a business as capital. He is the owner. He puts 20,000 as the capital. The answer is given here. In the J's business, now I said when it's come to accounting, all the accounting will be done from the point of view of the business, not from the point of view of the owner. Here the business is J's business and the owner is J. Even though J puts money as capital, right, we have accounted that as debit in cash, credit in the capital. Now, this is the answer, but I would like to know why we debit the cash account, why we credit the capital account from yourself. Why we debit the cash account, why we credit the capital account. There should be answers, right? Why we debit the cash account? You have to question. Why we debit the cash account? Cash is what for this business? Cash is what? Cash is an asset. Why we call cash as an asset? It helps to generate income for the organization. Therefore, by nature, cash is an asset for the entity. What has happened to the cash? When J puts money to the business, what has happened to the cash? It increases. Cash of the business got increased when J puts money to the business. Cash is an asset. Assets got increased. Asset increases are what? Debit entry. According to the double entry system. I know for sure that you have now by hearted the double entry system. According to the double entry system, asset increase, you have to put a debit entry. I'm again repeating the same thing. Cash is an asset. Assets got increased. According to the double entry system, when assets gets increased, it should be a debit entry. Why? Lookup passively say so. The double entry system itself say assets increase, you have to debit that account. Right? Here we know cash is an asset, assets got increased, therefore cash account will have to be debited. Every debit entry, every credit entry, you have to have reasons. Otherwise, you cannot debit or you cannot credit. You cannot question the double entry system, but you can question every transaction you are going to record. For every transaction you are going to record, there should be a valid reasons for you to debit or credit. Otherwise, you cannot debit or credit any account at all. For this cash account debit, we have a reason. Cash is an asset. Assets got increased. Therefore, it has to be debited according to the Luca Pacioli's double entry system. Therefore, we debit the cash account. Then why we credit the capital account? Because we are only left with the credit entry. No, there should be a reason. When J means the actual owner, he puts money. When actual owner's capital will increase. Owner's capital means equity. Equity also increase. Owner's claim, owner's entitlement will represent the equity. Therefore, when owner puts money, his entitlement will get increased. His entitlement represented by the equity account, equity also increase. When equity increase, go to the double entry system. What is the entry? Equity balance credit, equity increase credit, equity decrease debit. Therefore, here the capital account we credit because it is an equity increase. If I summarize the transaction again, when owner puts money, cash debited. Why? Cash is an asset, assets got increased. Then why we credit the capital account? We credit the capital account. Equity also got increased. When equity got increased, you have to credit, right? I think my explanation is fair enough for you to get a fair understanding about this transaction and how we record the transaction, right? Without seeing the answer, next transaction, make sure that you done for yourself. I will go to the next transaction, but don't see the answer first, right? Answer, but don't see the answer first. But make sure that you do yourself and whether you have learned the concept correctly. You have to check yourself, right? Purchase stocks or supplies paying 1,000 in cash for resales. They purchase some items for resale, right? If you are doing a business, your main item is purchase. That is for you to sales, you have to purchase. Sales means the main income item. Purchase means what? Purchase is the main expense item, right? For you to sell, there should be some purchases. Therefore, when sales is the main income, purchases are the main expense item, right? We are continuing the same entities books of accounts. Therefore, you can see cash account, you have a debit of 20,000. When you purchase 2,000 worth of items for resale, right? What will happen to your cash? It will get reduced. You have to pay cash. Cash is an asset. Assets get reduced or decreased. When assets decrease, you have to put a credit entry according to double entry system. According to double entry system, you have to put a credit entry. Right. Therefore, you have to credit the cash account by 2,000 and debit the purchase account. Why? Purchase is the main expense item. Purchase is the main expense item. When expenses are increased, you have to debit that account. When expenses are increased, you have to debit that account. Right? You have to debit that account when expenses are increased. Right. Therefore, for this entry, purchase debit, what is the reason? Expense increase. You credit the cash, what is the reason? Asset decrease. Asset decrease. Right. We'll go to the, you have to recheck with yourself, right? You go to the third example. Purchase equipment for rupees 15,000. Purchase equipment for rupees 15,000. Rupees 15,000. Now you can write down the answer. Don't see the answer. It is in the screen, but you have to write down in a separate paper answer. What is the answer? Purchase equipment. Equipment is what? Equipment is a asset. Asset. Why we say equipment is asset? It generates income to the organizations. That's why we say equipment is an asset. Now you know the characteristic of an asset. Characteristic of an asset, you know. Why we debit the equipment? We debit the equipment. Equipment are assets. Assets got increased due to this transaction. Equipment increase. Equipment means assets. Assets got increased. Assets got increased are debit entries. Right? Debit the equipment account, 15,000. Why we credit the cash account? When we purchase equipment, our cash will have to get decreased. It will get decreased. You have to pay the cash, no? Therefore, your cash will get decreased. Equipment increase due to asset increase. You have to debit the equipment account. Then you credit the cash account. Why? Your asset. There are two categories of assets relating to this particular transaction. Equipment also an asset, cash also an asset. Due to this transaction, one asset increase, another asset decrease. Therefore, when an asset is increased, you have to debit that asset. When an asset is decreased, you have to credit that asset. I think you are there, right? This is like spoon feeding, right? This is the basic level, the bottom level, and accounting can be taught to a student, right? Make sure if you have your sisters and brothers, younger sisters and brothers, or maybe your there may be children who are doing O level, low levels. Make sure they are not hearing this lecture. Otherwise, it is not good for you, right? But you have to learn these things from the very basics level, right? When you learn these things very basic level, you can build all number of stories in your building as far as accounting is concerned. It's a very basic accounting, but you have to learn the concept very correctly, right? If you learn this concept very correctly, you won't be retiring as a AGMO, DGMO, whatever the position, without knowing the biggest asset in your balance sheet. Even though you are working for 30, 40 years in the bank, and you are retiring as a person without knowing the biggest assets in your balance sheet. You won't be that kind of a person if you learn this concept very correctly. I am here to helping you to learn the basics thing. Thereafter, we will come to the material part. That's how we analyze the financial statements of a bank. Sorry, about entities. Right. We'll go to the fourth example. Here, the transaction is little bit different. That is, purchase stocks for 200 on credit, not for cash, right? Purchases, but this time not for cash, on credit, and another equipment not for cash by from A Limited, right? There are two transactions. All two transactions are on credit basis, not for cash. Now we take the first transaction, that is purchases on credit basis, right? Whether it is cash or credit, we had purchases. We had purchases. Therefore, it is an expense. Purchases are expenses. Whether it is on credit, whether it is on cash, we have done the purchases. Purchases mean expenses, expenses increase. Therefore, we have to debit the purchases account. Right? You can see 200 got debited in the purchases account. Right? Instead of paying cash, we commit a liability. We agreed with the creditors to pay this 200 in a future date. Right? Therefore, instead of paying cash, we commit a liability. Liabilities also got increased due to this transaction. This particular liability is referred to as a creditor, right? Creditor. Creditors are liabilities. Liabilities got increased due to this transaction. Therefore, we have to credit the liability account, that is creditors account. You can see number 4, purchases debit 200, creditors credit 200. Now, for creditors credit, liability got increased. For purchasers debit, expenses got increased. To come to the second part of the transaction, that is purchase equipment on credit basis from A Limited. Right? They have purchased equipment and asset from A Limited. Right? And assets purchase, acquired, assets increase. Asset increase means debit that account. Debit that account. Equipment account debit. Now instead of cash, now we done this transaction on credit basis. Therefore, that particular creditor has a name, that is A Limited. We have to credit that A Limited accounts. That is also a commitment. Until we get these creditors settled, it should be credit balance. Therefore, the second transaction, you credit the A Limited, you debit the equipment account. For equipment account debit, asset increase is the reason. For A Limited account credit, reason is liability increase. Liability increase. Right. Number 5. This particular company borrowed some money from the ABC bank. Borrowed some money from the ABC bank. Borrowed some money from the ABC bank. What has happened? Now, when you borrow some money, you will have some cash. Therefore, your cash will get increased by that amount. We debit the cash account 4,000. We debit the cash account 4,000. And when somebody gives cash to you, one day you have to repay. Right? One day you have to repay. That is a commitment. Therefore, there is a commitment called ABC bank loan. ABC bank loan, you have to credit that. Right? Number 5, transaction. Number 5, cash debit 4,000. Why? Asset increase. Cash is an asset. Asset increase. You credit the ABC bank loan account. Why? Commitment or liability increase. Liability increase. Liability increase. That is how you have to done your double entries with reasons. If you know the reasons first time, there in the second time when you do the same kind of transaction, you need not to recall the reasons, but you have to know. You have to know. Up to now, I know for sure everybody listen to this lecture won't know about these particular reasons, even though they are doing these double entries for years and years. Right? When it's come to the teaching of subject of accounting from O levels, A levels, nobody will do like this. They just say by heart these things. right? Now, I was a university lecturer when I got through my university exams. I got a first class, and initial my job was a lecturer at University of Jawaharlandpura, attached to the management faculty. I spent there 2 years as a permanent lecturer. When I come across the people who are the best 1,000 people in A-level commerce stream come to the Jawaharlandpura University for their higher educations, right? Even though best thousands people are there, the highest persons who got the highest ECID marks in the commerce section, right? All of the people are very good by hearters, by heart, right? They by heart the subject of accounting as well, because they were like parrots, right? When you ask for a double entry, they will give this thing, but they don't know the actual reasons why it has actually happened. Therefore, I emphasize accounting is not a subject of by heart. The only thing for you to by heart and accounting is the double entry system. Every other parts, all the double entries, you have to have a reasons, right? Otherwise, you cannot do that double entries. When you know the reasons why you debit, why you credit that account, then when it's come to analytical, when it's come to interpretation, when it's come to uh, preparing reports, you know why it is as accounted like that, and you can give a better explanation to the parties you are going to present that thing. All right. Now, finally, this is how you balance an account. Cash account, you had about after 5 transactions, this is the cash account. When you are balancing the particular account, you have to go to the debit side and the credit side, and you have to take the total of the debit side and credit side. In the debit side, you have 24,000. In the credit side, you had 16,000. You have to take the highest value, that is debit side value. You put the debit side value to the two sides, debit and credit, 24,000, and get the balance from the credit side, that is 8,000, and that is called balance carried down, and balance brought forward from the debit side, that is 8,000. Now, if you take an account, the balance of an account will be reflected the balance brought forward one, not the balance carried down one, balance brought forward one. If you take this cash account, it has a debit balance of 8,000 for the cash account, right? Then apart from that, to take a trial balance, the balances of likewise the cash account, balances of all these accounts, you can prepare a trial balance. Now, if you take this particular 5 transaction, I have prepared a trial balance, that is the balance of the cash account is 8,000, balance of the capital account is 20,000, balance of the purchase account is 1,200, balance of the equipment account is 16,000, debit balance, creditors account 200, credit balance, A limited account, credit balance 1,000, ABC bank loan account, credit balance 4,000. Your debit totals and the credit totals will get tallied, right? That is also not a magic, right? If you debit the same value, if you credit the same value, your debit totals and credit totals will get tallied, right? There can be errors, even the trial balance is tallied, there can be errors you can come across, right? Now I'll come to some examples again for a bank, right? For a bank, if you take some example for a bank, a customer makes a deposit. A customer makes a deposit, right? When a customer makes a deposit of 4,000, what will happen? I gave the answer also, right? From your early days as tellers, you do this accounting transaction, you do this double entry without knowing this. Now, what you do is, when customer makes a deposit, you debit the teller cash account, you credit the customer's deposit account or customer's account, right? Whether it is a saving account, whether it is a current account, whatever the account you credit is. Whether it is a fixed deposit also, you credit it. Now my question is, why you debit the teller cash account, why you credit the customer account, deposit account? Now you can say the answers. Now you are in a position to say good answers, very valid answers for my question. Unfortunately, you are not physically present. I know for sure now you can tell the answers. Why we debit the teller cash account? From the bank's point of view, they receive the cash. Teller cash is also a cash account. Now, if you take a bank, there are different kinds of cash accounts. Teller cash account, ATM cash account, vault cash account. There may be what is called this. Now, I'm not getting that name. There are different cash accounts, right? Teller cash, vault cash, ATM cash, all are cash account, right? Cash is what for a bank? Cash is an asset, right? When customer makes a deposit, bank receive cash, right? When cash is received, asset increase, right? When an asset is increased, it should be a debit entry. Therefore, we have to debit the teller cash account. Right? Why we credit the customer deposit account, savings account to current account? Why we credit that? Because we are only left with the credit entry. No. From the bank's point of view, when you accept a deposit, means you commit a liability. One day, this deposit amount will have to get repaid. When customer comes again and asks for his deposit, we have to repay. Therefore, bank's point of view, when you accept a deposit, that is a liability. Therefore, when you accept a deposit, your cash increase, asset increase, then you debit the teller cash. Similarly, you commit a liability where liability increase. When liability is increased, you have to, according to the double entry system, what will happen? Liability increases are credit entry. Therefore, you debit the teller cash account, you credit the customer deposit account. Debit the teller cash account, credit the customer deposit account. Right? Therefore, for this debit entry and for this credit entry, now you have valid reasons. Even though at the inception of your banking career, you did this entry and your subordinates also doing this entry, you don't know the reason, right? When I interview most of the people for promotions, everything, I normally ask this question: what is the entry you post when you customer? They give the correct answer. We debit the teller cash and credit the customer account. Then my question is, why you debit the teller cash account? Why you credit the customer deposit account? They don't know, right? Right. And for this second example, customer withdraws 2,000 from the counter, right? From the counter, he withdraws. Now, if you take this particular customer, maybe assume that he has a 3,000 balance in the account. Then he withdraw 2,000 from the counter. Very rare now these days. People come to withdraw 2,000 from the counter, but for a time being, assume that it has happened like that way. What will happen? You have to debit the customer deposit account. You have to debit. Why? Why you have to debit the customer deposit account? Your liabilities got decreased. When customer gets some money from his account, bank's liability to pay the same amount will get eliminated, right? Now he cannot come and again. Initially he had a 3,000 worth of cash in his account. Now he take 2,000. Again he cannot come and ask for 3,000. Therefore, our liability will get reduced. From the bank's point of view, our liability will get reduced by 2000. Therefore, we have to debit. Liability decrease means debit according to the double entry system. Liability decrease, debit balance. Therefore, we debit the customer deposit account and credit the teller cash account, because the cash in the teller will get decreased, right? Whether it is ATM cash or teller cash, it will get decreased. Cash decrease means asset decrease, credit entry. Therefore, you can see number 2, customer deposit account debit. What is the reason? Liability decrease, teller cash account credit. Why? Asset decrease, right? Normally I don't have feedback physically. If it is on physical, normally I will have to spend more time explaining these things. But I know for sure, if you getting the things correctly learn. But anyway, if you have any question, you can ask any question from me. Via I will give the mobile number to the course coordinator, and he will ensure that if you have any question, you can contact me. Right. Anyway, we'll be discussing in the last uh, uh, 2 lectures the past papers and the other necessary sums for the exam. But if you have up to now, if you have any question, you can ask from him. Right. Right. Now, up to now, what we have learned? We have learned the double entry system, right? This is the double entry system we have learned. We said there are 5 categories of accounts: asset, liabilities, income, expenses. Then every account has a balance according to the double entry system. Every account has a balance, that is debit balance or credit balance. Asset account, debit balance; liability account, credit balance; income account, credit balance; expense account, debit balance; equity account, credit balance. When due to transaction, asset account, if asset accounts increase, you have to put a debit entry. If it is a decrease, you have to put a credit entry. Similarly for other accounts, right? Now, for the sake of by heart in this thing, you have to only by heart the account category and balance column. The balance column is identical to the increase column, and the decrease column is the other side of the increase. Then we learn about what is an asset, and different asset categories, right? A main characteristic of an asset is it should generate some income to the organization. If an item is not generating income to the organization, you cannot recognize that item as an asset. If it is not generating income to the organization, you cannot recognize that item as an asset, right? Assets are shown in the balance sheets. Assets are shown in the balance sheet. You can see. And it should be owned and controlled by the entity. And different categories of asset by time. You have non-current assets and current assets. Non-current assets are the assets that generate income for a longer period of time, whereas current asset only generate income for a shorter period of time. When it's come to tangibility, that is for you to touch, for you to smell, for you to hit. Based on that criteria, there are 2 categories of assets, that is tangible assets and intangible assets. To take tangible assets, the asset that you can touch, feel, and hit, those are the assets called tangible assets. More than 99% of the assets are tangible assets. Then when it comes to intangible asset, there are second category of asset, that is intangible asset, where you cannot touch, you cannot smell, you cannot hit, right? But those are also generating assets. I explained, if you take debtors, if you take investment, those are called intangible assets. Even though they are generating income, we cannot touch or smell those assets. Then the third category of assets are fictitious assets. Those are bogus assets. Even though we say these are assets, they are not generating any income to the organization. That's why we say fictitious assets. Right. Then the second category is liabilities. Liabilities are commitments, right? When you are doing business, business organization commit various things. Those are called liabilities. Liabilities are also shown in the balance sheet or the statement of financial position, right? Claims on our assets are called liabilities. Liabilities also we categorize based on two parts: by nature, internal and external, right? Uh, Even though here internal liabilities we call equity, even though owner is putting money, we say that is also liability in the big picture, right? Because we are accounting for business, not for the owner, right? Therefore, when the owner puts money, that is also considered as a liability, but it is a internal liability. We have another name for internal liability, that is equity, right? Apart from the owner's claim, a balance part is called external liabilities. External liabilities can also be categorized based on time, non-current and current liabilities. If you take non-current means a liability that you take more than 1 year period to repay, right? If a liability will get repaid after 1 year, normally we take bank loans and debentures. Those are called non-current liabilities. Those are called non-current liabilities. If you take current liabilities, if a liability will get paid within 1 year, those are called current liabilities. Normally we take examples as creditors, bank overdraft. Those are non-current current liabilities. If you take the subject of current liabilities, bank overdraft. Bank overdraft for a normal business is a current liability, but for a bank overdraft is a asset. Bank overdraft is an asset because it generates income to the organization. Simply that. If some item is generating income to the organization, that is an asset. If some item is a commitment for that organization, that is a liability. Very good example is the bank overdraft. For a bank, it is an asset. For a normal business organization, it is a liability. Then we took equity. Equity based on the nature of the business, equity will get differ. In a big picture, equity means the internal liability. You know, equity account should have a credit balance, increase credit, decrease debit. In Sri Lanka, there are three categories of business. When you are going through the proprietorship accounts, the equity will get represented by way of a capital account. If you have a customer which is having a partnership, right? If it is a partnership, the equity will get represented by two accounts, that is capital and current account. In case of a company, equity will get represented by way of stated capital and reserves. Stated capital and reserves. Equity also shown in the statement of financial position, you know. Then expenses, I explained, right? Expenses are to be incurred to generate income. Main two categories of expenses are capital expenses and recurring expenses, but we normally treat only the recurring expenses as the expenses. Capital expenses are result in a non-current assets, right? A non-current asset. Therefore, capital expenses are not normally be treated as expenses. Normally, the recurring expenses. If you take the characteristic of recurring expenses, those are called normal expenses. But if you take the characteristic of capital expenses, those are assets. Right. Then income, whatever the cash flow generated through or receipts to be received are called income. Right. Income also main income and other income. Every organization has a main income. And if you take insurance industry, main income is the premiums that they receive. If you take a telecommunication industry, the main income might be the prepaid and postpaid telecommunication income. And if you take a bank, the main income is the interest income, right? If you take a normal business organization doing selling and or trading business, those businesses, the main income is the sales, right? One item may be due to the nature of the industry within which they are operating, a particular item may be a main income. For some industry, particular item may be a other income. If you take interest income is the main income for a bank, whereas interest income may not be the main income for insurance sector. Or insurance income for an insurance company, interest income may be a other income, right? Then we learn about the accounting equation. We started from the debit and credit equal and put the 5 categories into the equation. Assets and expenses have a debit balance. Income and expenses and income and equity and liability have a credit balance. We extended the equation and finally come to a conclusion. Assets equals liability plus equity plus income deduct expenses. That is the final equation. Then we went through the format of a ledger account, right? Then we analyze some transactions. We got to know about how double entries are being posted and the reasons within which we have to post the double entries. And we learn about how we balance an account, how to prepare trial balance. Then we went through some transaction, particularly to a bank with reasons for debit and credit entries, right? Then the next topic is the primary books. I'm not going to detailedly explain about each and every of these primary books, but you have to get a basic understanding about the primary books when you are working as a credit manager. Now, these primary books are normally used when there are bulk of transaction happening in a every day. If the transaction, the volume is too high, you cannot always update the ledger account each and every time a transaction happen, right? Instead, you initially record the transaction set of books called primary books. Now, these are the main books that we record the transaction. After a period of say 1 month, 1 week, 2 weeks, the summary of the transaction recorded in the primary books will get captured in the ledger accounts, right? Similar transaction will be recorded in the same primary book. If you take the purchase day books, all the credit purchases will get reflected or will get recorded in the purchase day book. All the credit sales will be recorded in the sales day books, right? Likewise, we recorded the transaction initially in the primary books. On a periodic basis, the summary of the value will be recorded into the ledger accounts. If you go through the set of primary books I mentioned here, if you take the cash book, there can be single column cash book, double column cash book, triple column cash book. I will take 1 minute. A single column cash book will be used by companies when they have transaction done only in physical cash, not using checks, right? In that case, a company will use single column cash. Very rarely you find customers of this kind of nature who are using the single column cash book, but there can be customers, right? Double column cash book where you have customers who are having not only the physical cash but using checks also. We'll go to the one by one. Now this is the single column cash book format, right? You can see the date, description, ledger page, cash receipt number, and cash. Now every of these primary books will have a source document to support that. Every single transaction recorded in the primary book. Therefore, when it comes to cash, there should be a cash receipt, right? You are also, when you are visiting the factories of particular clients, make sure that you take into account these points also. When they have a cash book, you have to make sure that there is a process of issuing receipts for every cash received by the particular entity. If the receipt is there, then you can say the source of funds from the particular cash amount, right? Similarly, when you go to the credit side, when a cash payment is done, there should be a payment voucher. A payment voucher should be there. A payment voucher should be issued and it should be supported by the source documents, right? And a payment voucher should be recommended by one person and approved by another person. Those are called good practices, good internal control systems, right? Make sure that your clients also possess those internal controls when they are doing or when they are recording transaction also, right? Educate your clients always on that aspects also, right? When you are doing a visit to the client physically, I know for sure that you are visiting clients. Make sure that when it comes to these small and medium or SME customers, those people have these good practices, right? If you do have cash receipts, if you do have payment vouchers, meaning there is a control, right? Even the auditors come to visit to check the balances. They can provide all the source documents attached to this cash receipt and payment vouchers. This is the double column cash book, the same as the single column cash book, but in addition to the cash column, you have a bank column also, because these people, they are having a current account in a bank and they are issuing and they are doing transaction using checks, right? I'm not going into detail, it will take some time, but for the benefit of all the people, I'm giving these formats for you to get an understand. If you are really worried about these things, you can ask if you have any friends or any relations who are doing A levels. They have a number of questions in these areas. Triple column cash book. Triple column cash book means when you are doing cash, instead of cash and cash sales and cash purchases, you are doing credit sales and credit purchases. In that scenario, you may come across debtors and creditors. Right? When you have large number of debtors, meaning your cash is held up with those debtors. In that case, you can encourage your debtors by giving some discounts, right? You have to have debtors, right? For you to increase your sales, you have to do the sales on credit basis. When you are doing sales on credit basis, you have debtors. Now, debtors will take some time to repay the cash, right? For that time period, your cash is uh, uh, your cash is fixed with the debtors. If you are having an overdraft with a bank, you are paying overdraft interest for that also. When you receive cash from debtors, you can settle down the overdraft itself. Therefore, it is very important to take cash in an early day, not having the total period from the debtors. For encourage that, you can ask debtors to repay the cash uh, very early and by giving some discounts, right? When you give discounts, those are called discounts allowed. It will be an expense, but you receive the cash at a early date. By using that cash, you can repay your commitments. Similarly, on the other hand, when you do credit purchases, you come across creditors, right? When you do credit purchases, you have creditors. Creditors also may have the similar strategy. They may also encourage you to repay the cash, right? They may also encourage for you to pay the cash to settle the creditors. In that case, you will receive discounts from them. Those are called discount receipts. Discount receipts are income, discounts allowed are expenses. Now, in the triple column cash book, you have these two columns apart from the cash and bank columns. If you have discount received, if you have discounts allowed, you can record in this cash book that is called triple column cash book. Then this is a purchase journal. Purchase journal is normally we use to record all the uh, credit purchases done for resales. When you purchase items for resales on credit basis, those are recorded in the purchase journal. Those are recorded in the purchase journal initially. If you have a bulk of transaction in a given day, that is recorded in a purchase journal. Then for the purchase journal, we used to take purchase invoice for the recording purpose, right? And on the other hand, the sales journal, if you take the sales journal, when you are doing credit sales for all the resale items, those are initially recorded in the sales journal. Those are initially recorded in the sales journal. All the sales done on credit basis for resale item. This is the format of a sales journal. And on a periodic basis, from the purchase journal and the sales journal, you take transaction to the ledger. How do you take the transaction to the ledger? You have to debit the debtor and credit the sales. In case of purchase journal, you have to debit the purchasers and credit the creditors. And similarly, return outward means when you purchase something, if you are not happy with the items purchased due to quality, due to quantity, due to various other brands and various damages, you can return those items to the original supplier. Then when you are returning those items, those are called returns outward. It has to be recorded in this journal initially, thereafter the ledger. Similarly, once you sold items to the customers, if they are not happy with the items that they have purchased, they can return to us, right? Those are called returns inward. Return inwards also will get captured in the return inward journal. It has to be recorded here first before going to the ledger accounts. I am not going to explain these journals. You have to find yourself to have some better explanations if you really want these things. Right. Then this is a format of a petty cash book. Instead of a main cash books, most of the organizations are using the petty cash books also for the recording of small amount transactions like donation, purchasing of various soaps, various sanitary items, right? Now, if you take a bank also, now all the transactions are normally happen in millions, thousands. Now, when there are transactions happen in very small amounts, it is very difficult for you to record all transaction in the uh, if you take all transaction recorded in the main cash book, even with these very insignificant values, it will the main cash book will get complex and will get extended to pages and pages. It will be a very cumbersome process. Therefore, to avoid that thing, people used to have a petty cash book instead of the main cash book for small type of transactions. And this is the normal format that they use. Uh, uh, from the time to time, a person called petty cashier will get appointed, and he will be given an amount at the beginning of the month called petty cash imprest, and ask that person to explain using that petty cash imprest. And after say after 1 month, the petty cashier will come to meet the main cashier and provide all the bills and get the imprest reimbursed. And that is how this petty cash system is normally happening in a normal business organization. Those transactions will get recorded a book like this called petty cash book. Right. Then the final journal is the main journal. Final journal is the main journal. If you take the main journal, all the other transactions not recorded in the other journals are recorded in the main journal. If you want, you can write down the main transaction that are recorded in the main journal are opening entries. Then the number 2 is purchase or sales of non-current assets on credit basis. Those are also recorded in the main journal. Then when you are correcting errors, those are recorded in the main journal. Then closing entries are also recorded in the main journal. Finally, the adjustment entries also recorded in the main journal. We are not going into detail. Right. I think that part summarizes the basic accounting understanding for you to learn the balance part of the subject. That is how you analyze and interpret the financial statement of an entity. Now, coming back to the main topic, that is financial statements. You have to have a good understanding about the financial statement preparation process. What will happen is normally every business organization have a financial calendar. Maybe starting from 1st January to the December. Some business organizations have 1st April to the next year 31st March. Some financial calendars, some people have 1st July to the next year 30th June. Some may have 1st October to the 30th September. Right. Likewise, different entities have a financial calendar. We said normally it will be 1 year period. Right. In most of the cases, the more frequent financial calendars are starting from 1st January to 31st December. And the other most popular one is the starting from 1st April of 1 year to the 31st March of the second coming year. Then if I explain the financial statement preparation process, from the beginning of a year to the end, all the transactions are recorded. And if you take the 5 items, I mentioned the 5 items, if you can remember: asset, liabilities, equity, income, and expenses. You take the last 2 items, income and expenses, they will only last for a particular financial period. That is for 12 months only. If you take 1 year's income and expenses, say 2019 income and expenses will not carry it forward to the 2020. But in case of other 3 items, asset, liabilities, and equity, if there are balances remain at the end of the 2019, it will be brought forward to the 2020. I repeat the same. If if you take items, income and expenses, the balances at the end of these income and expenses will not be taken into the next year. It will only last for that particular year only. We zero their balances and take the balances of income and expenses to the income statement and calculate profit. Every income account, every expense account will be zeroed at the end of the year, and their balances, respective balances, you know, income account, there is a credit balance, income expense account, there is a debit balance. The respective debit and credit balances will be taken to the income statement. And every year end, income and expenses balances will get zero, right? Therefore, no balance at the end of the year for income and expenses. The balances will get transferred to the income statement in order to make the, or in order to calculate the profit. But in case of the other three items, asset, liabilities, and equity items, their balances will be carried out to the next year, right? If there are balances, it will not last for that particular year. It will be carried out until, if an asset, until that asset will get realized, until, if it is a liability, until that liability will get settled. If it is a equity, until it will get settled, right? If there are balances, they will be carried forward to the next year. That is a very important point. Therefore, at the end of each financial period, at the year end, all the transaction, recorded transaction, we have to prepare a trial balance. From the trial balance, we can prepare the income statement and the statement of financial position. That is the main two statements, right? And the point you have to know, nothing will be carried out from an income account or expense account to the next year. But in case of asset, liabilities, and equity, the balances remain at the end of the year will be carried out to the next year. And you know already, asset, liabilities, and equity will be presented in the balance sheet or the statement of financial position, but income and expenses will go to the income statements, and they will only last for that particular year. When you are starting a new year, balances can only be seen in your asset, liabilities, and equity accounts, not for income and expenses. At the beginning of a financial year, balances in the income and expense accounts will have to be zero. If not otherwise, that is incorrect, right? Then that is the preparation of financial statements. We have to prepare the trial balance. From the trial balance, we prepare the income statement and prepare the statement of financial position. Then component of financial statement, we have already discussed. You know, there are 6 components starting from income statement, statement of financial position, cash flow statement, statement of changes in equity, accounting policies, and accounting notes. One by one, we will explain in the latter part, right? Then we have to know financial statement of different entities. There are some format differences, but as a whole, Sri Lanka Accounting Standard 1, LKS 1 will give the formats for all industries except for banks. In case of a bank, the central bank has issued the format of a financial statement of a bank. We have to follow that format because bank balance sheet and the income statement is different from other entities. Therefore, there is a specific format to be followed by banks when they prepare the financial statement. But apart from that, all other industries, they have to follow the LKS 1 format. they have published a format LKS 1.4. We are not worried about the bank's financial statement since you are not going to lend you are not going to lend funds to the banks. We are worried about the other entities financial statement. You have to learn about the other entity financial statement. Uh, uh, we will give the formats for you to study, right, at that junction. But if you take the financial statement of different entities, you may have clients from different industries: insurance, telecommunication, trading, maybe estates, tea estate, coconut states, right? Various other industries. Therefore, when you have a financial statement of different entities, every different entity or the industry, there are particular technical jargons. Now, if you take the state in the industry, that is tea, coconut, rubber industry. If you take the word nurseries. If you take the word nurseries, that has a meaning for that industry. Normally, if you take nurseries, our mind call into the concept Montessori. Now, when it's come to these three industries, tea, rubber, coconut, nurseries means not Montessori, right? They are, some people may know, it is called, the definition of nurseries, that they define nurseries as fresh plants, right? That is an asset. That is an asset for that industry. Therefore, there are different jargons for every industry. If you take the hotel industry, you have a different jargons like refurbishment cost, like occupancy rates, right? If you take the hotel industry, those are the technical jargons. If you take another industry, telecommunication, prepaid, postpaid, right? Various other technical jargons are there. Therefore, very important, right? Now we will in detail talks about these things. When you are analyzing the financial statement of a different industries, you have to have a good industry knowledge. If you don't have a good industry knowledge, now if you take the tea industry itself, when tea tea is plucked from the state, you have a different wage, right? It might be a 10 kilo from a particular plucker. Then from the 10 kilos, you can ultimately produce maybe 250 uh, milligrams, 250 milligrams of produced tea, finished tea. That is a formula. You have to know those formulas, right? Therefore, gaining industry knowledge, gaining technical jargons knowledge of a particular industry is very important when you are analyzing the financial statements of different entities. We'll come to that in later stage. Then the formats of financial statements, it more or less similar, but there can be differences. There can be different words, like I mentioned. Right. If you take this particular subject, accounting standards, I am just giving some background for the subject. Now, in the morning, up to now, we learn about the basic concept of accounting. Now, we are coming back to accounting standards. To take the accounting standard, Sri Lanka accounting standard, previously known as in 2012, it was known as SLA, Sri Lanka Accounting Standard, but now referred to as SLFRS, that is Sri Lanka Financial Reporting Standards, and LKS, Lanka Accounting Standards. Now it is normally the duty of Institute of Chartered Accountants of Sri Lanka, ICASL. Normally nowadays we call CA Sri Lanka, Chartered Accountants of Sri Lanka. It's their duty to produce new accounting standards. There is an act called number 15 of 1995 Sri Lanka Accounting and Auditing Standard Act. Via that act, the Sri Lanka, or the Institute of Chartered Accountants of Sri Lanka, is the main accounting body in Sri Lanka, right? Via that act, it gives powers to the CA Sri Lanka to produce new accounting standard, or to amend the existing accounting standard, or to abolish the existing accounting standard. Three things: introducing new accounting standards, abolishing the existing accounting standard, or to amend the existing accounting standards, right? For do that, the CA Sri Lanka, they have appointed a committee called Sri Lanka Accounting Standard Committee. Normally, the president of the Accounting Standard Committee will be the president of the CA Sri Lanka, and the bulk of the members will be chartered accountants. And there are representatives from the central bank, representing the central bank governor. There are representatives from the SIMA Sri Lanka. There are representatives from the company registrar. There are representatives from the Ceylon Chamber of Commerce. There are representatives from the Federation of Chamber of Commerce, right? But the bulk of the members of this Sri Lanka Accounting Standard Committee is chartered accountants. And their duty is to produce new accounting standards and abolish existing accounting standard if they have no use, and they can also amend the existing accounting standard in line with the new practices, right? Once they do that, for they assume that they are going to implement a new accounting standard, right? They have to first initially draft the proposal and approved in the accounting standard committee, and it has to be go to the council of the CA Sri Lanka. Once the council approve, it will go to the parliament. You know, now these days the parliament election is happening. No, now if a new accounting standards comes to the parliament approval, normally, you know, something goes to the parliament, there will be a lot of debates, no? Opposition and the government will have a lot of debates on something presented to the parliament. But surprisingly, when these accounting standards, new accounting standards are presented to the parliaments, there won't be much debates, because most of the people, they don't understand this new accounting standard. They will pass those things. And once the parliament approval is taken, it will be gazetted, and it will become the laws and pillars of the country. Therefore, it will be a law. The violation of the law will be a punishment by the entity. There are various rules, various regulations implemented by the use this accounting standards, and there are powers given by the particular act I mentioned, 1995, number 15, Accounting and Auditing Standard Act. There are some monetary boards also, Sri Lanka Accounting and Auditing Standard Monetary Boards, SLMB, and we have to follow when we prepare the financial statements. We have to follow these accounting standards, because those are laws of the country. And apart from that, some organizations, not only the accounting standard, there are some regulatory things that you have to follow. If you are a company, you have to follow the provisions in the Company Act. If you are listed in Colombo Stock Exchange, you have to follow the Security Exchange Act ruling. If you are a bank, you have to follow the Banking Act. If you are an insurance industry, you have to follow the Insurance Industry Act. Likewise, there are other rules also apart from the accounting standard. There may be other rules that you have to follow, right? I mentioned earlier also, up to 2012, the accounting standards are known to people as Sri Lanka Accounting Standard, SLAs. Now after 2012, accounting standard are now known as SLFRS and LKS. Right. For me, today is right. I would like to wind up the session now. My request is for you to join the next Sunday sessions at 7 a.m. and before I end up the session, some people are going to withdraw from the session, but make sure that you are there, right? Still, I am doing the lecture. What I wanted for you to, for the next session is you have to come up with the learnings that I provide you today. I make an effort for you to get an basic understanding about the basic accounting techniques, basically the double entry system. When we come to the next session, it will be more useful if you go through the presentation slides I shared. If you come up with the better understanding of what I have done up to now, then it will be very beneficial for the next session onward. It will be like a chain. But now it will be a week time for you to get an understanding about whatever the learning I presented to you. If you have any question, doubts, you can ask from the IBSL, the contact numbers, and you can clear those doubts, giving me a call. Thank you very much for the support, and we'll meet next week at 7 a.m. Thank you.